Hi, everybody, and welcome back to the channel Global Dividend Strategy. Today, we're diving into what could be a hidden gem in the dividend investing world, South Bow Corporation, ticker symbol SOBO, which currently offers an impressive dividend yield of 7.5% or $2.77 per share. If you're looking for high yield opportunities with long term potential, this is a company worth examining. Now let's break down how SOBO originated, why it could be an opportunity for dividend investors, and the key factors to consider before investing. SOBO emerged as a spin-off from TC Energy, ticker symbol TRP, a Canadian energy giant with a market cap of over $70 billion. The spin-off occurred in October 2024 when TC Energy decided to separate its liquids pipeline business into an independent company, SOBO. TRP shareholders were awarded one share of SOBO for every 4 shares of TRP they held. This strategic move allows TC Energy to focus on its natural gas and power segments, while SOBO can dedicate its resources to the liquids pipeline business. From an investor's perspective, spin-offs like this often unlock value by enabling both companies to pursue tailored growth strategies. It also creates opportunities to invest in niche segments with more focused operations. Despite being a new standalone entity, SOBO isn't starting from scratch. It inherits a strong foundation from TC Energy, including 4,900 kilometers of crude oil pipelines connecting Alberta crude to major U.S. markets, a market cap of over $7 billion, providing it with scale and stability, and a 20% stock price increase since its IPO, signaling early investor confidence. That said, SOBO is technically a new company, which carries higher risks due to limited operational history and a lack of standalone financial track records. However, this risk may be offset by its legacy infrastructure, TC Energy's reputation, and its strategic role in the energy supply chain. SOBO's dividend yield of 7.5% is undoubtedly attractive, but what about its sustainability? The current payout ratio stands at 118%, which is above the ideal level. However, it's worth noting that major credit rating agencies such as Moody's, Fitch, and S&P give it a relatively strong BBB- rating. This is because the debt is being used for strategic expansion. To give more detail, SOBO has a debt of $7.9 billion with an average 5.67% interest rate, which is on the higher side due to the maturities ranging from 3 to 30 years away, which helps the company minimize long-term refinancing risks, which is a prudent low-risk financial strategy. This debt was taken on to fund strategic expansion and infrastructure improvements, as it is projected that the supply and demand for oil in North America and by export markets will exceed pipeline capacity in 2026. Therefore, it is necessary to expand the pipeline not to miss out on future revenue. While the high payout ratio might appear alarming, this is a calculated move common in capital-intensive sectors like energy. Another reason for the higher payout ratio is the high yield offered on the dividend to attract new investors. As a new entity, SOBO's management set an attractive dividend yield to draw in investor interest. Over time, as earnings grow and debt is reduced, the payout ratio should normalize. Given these factors, I believe that $2.77 per share dividend is sustainable in the long term, especially as the company's expanded infrastructure begins to generate additional revenue. SOBO's future looks promising due to its strategic focus on crude oil transportation, a sector that remains critical despite the energy transition. Its existing infrastructure and connections to high-demand U.S. markets position it for stable cash flow generation. While short-term volatility is possible, the company's legacy assets, strategic importance, and potential for long-term earnings growth make it an intriguing option for dividend-focused investors. So, how should investors approach SOBO? Here's one way to go about it: dollar cost averaging. If you invest at the current price of $36.95 per share, you lock in a dividend yield of 7.5%. However, as SOBO releases its first standalone earnings report in March 2025, the stock price could experience volatility. If the price declines post-earnings, consider adding to your position, effectively increasing your dividend yield. If the price rises and you're confident in the company's fundamentals, you could still add to your position to benefit from potential capital appreciation. This strategy helps mitigate risk by avoiding the pitfalls of market timing and allows you to build a position gradually. In summary, South Bow Corporation is an interesting dividend play for those seeking high yields and are willing to take on some additional risk. Its origins as a TC Energy spinoff, its strategic positioning, and attractive dividend yield make it a compelling consideration for income-oriented portfolios. Well, this will be it for today's video. I hope you found this quick analysis interesting and useful, and please don't forget to hit the like button and subscribe for more videos and strategies on dividend-paying companies. And of course, let me know in the comments what you think about SOBO or if you have any questions. Thanks for watching, and I'll see you in the next video. Have a great rest of your day.